Keep calm. And carry on buying AI tech stocks as they deviate from the highs. Where the greater the deviation, then the greater the buying opportunity presented. Keep calm and carry on buying. Quantum AI tech stocks. UK house prices were soaring out of control. Inflation, crashing British pound, soaring interest rates, bond market panic that's prompting the banks to withdraw literally half the mortgages on offer. All the fixed rates are gone. Just overnight, literally overnight. And now the Bank of England panics and pivots on QE.
We've just heard from the Bank of England just now, Jane, with a rather extraordinary statement saying that they are planning a gilt market operation, which is an intervention from the Bank of England, they say, to try to restore orderly market conditions. Let me just read out part of this statement, literally just in the last few minutes from the Bank of England. They say, as the Governor said in his statement on Monday, the bank is monitoring developments in financial markets very closely in light of the significant repricing of UK and global financial assets. The repricing has become more significant in the past day and is particularly affecting long-dated UK government debt. Now, what they're talking about there is essentially part of the thing we've been talking about recently, the yields on government debt, which have spiked up to the highest rate that we've seen since the financial crisis. The statement goes on, were dysfunction in this market to continue or worsen, there would be a material risk to UK financial stability. This would lead to an unwarranted tightening of financial conditions and a reduction in the flow of credit to the real economy. So essentially saying that this could, well, we're already seeing it, aren't we? You were just talking to Ian about this, the fact that mortgage lenders are pulling some of their products because of what's happening right now.
So instead of reducing the bank's balance sheet, they're going to buy more bonds, monetize more government debt, more money printing, more inflation. So are now how house prices going to crash, collapse, enter a bear market? Well, my extensive full spectrum analysis that concludes in a detailed 3-year trend forecast that was first made available to patrons who support my work. So, for immediate first access to all of my analysis and trend forecasts, then do consider becoming a patron by supporting my work for just $4 per month, which is nothing for what you're gaining access to. So, my housing market analysis was on an epic scale. So, I'm just going to skim through it, yeah, rather than go through it, because I'll be here for hours if I had to actually go through it on this video. So, but if you do want to read it, then follow the link in the description and you can read the whole analysis. Gain access to it now. So let's get on with it. What does my housing market analysis say? And what is the detailed 3-year trend forecast? Yes, I can have the inflation mega trend. Look at that, disposable earnings are collapsing. They were forecasted right, but they're not going to actual versus fiction of the government's forecast. ONS, OBR. The inflation megatrend means the pound has lost 66% of its value and is losing now at 10% per annum. Oh, the only thing they can do is print more money. The Bank of England's already pivoted. So what do we do under these circumstances? Well, we have no choice but to invest in assets that cannot be printed. This shows you the breakdown of my assets. Most of my assets are in bricks and mortar. That's housing, not housing funds, but physical housing. 44%. When I did this update in January, you can see the breakthrough down in stocks. It's basically 40%, but 10% was in cash in January. It's changed a lot since, so I've ploughed more money into stocks. And all about the inflation. All you hear is garbage about deflation from the clueless. This is what the GFC deflation looks like. Brexit deflation, pandemic deflation. Look at them, they're just mere blips. There is no deflation, can't you see? This is the UK CPI index showing you that the inflation megatrend is exponential. So what do? You have to leverage yourself to inflation by being invested in assets that cannot be easily printed. Housing cannot be printed, but stocks, certain stocks that have strong cash flow and a good profit margin, they can't be printed because they're usually buying back the shares, like Google to some degree. Most of them are. This is what I've been flagging all the time. You have to be aware that deflation, there is no deflation. They're just mere ripples on an ocean of inflation, as this chart illustrates. I'm not going to go through it all. This is the Fed's inflation strategy revealed at 4%. Oh, it's a little higher than our target, but it's definitely transitory. Inflation, it's 5%. Oh yes, it's definitely transitory. This is Jerome Powell, the clown in charge of the Fed. When then 6% inflation, oh, it's persistently transitory, but it will soon fall all on its own in Q3. That's Q3 2021. Inflation 7%. Hallelujah, inflation has finally peaked. This is what it was like. This is their strategy, the Fed's. Inflation 7.5%. It's the top now, definitely. Inflation 7.9%. This is really the top for sure. We got this. We pressed the red button on the keyboard. Inflation 8.5%. This is all Putin's fault, not ours. He's just invaded Ukraine and inflation has peaked at 8.5%. Inflation 10%. Nothing to worry about. It's to be expected with Ukraine war raging, China lockdowns, plus the market has already all priced it in. Inflation 12%. There is no way this is not the top now for sure. Inflation 15%. Okay, you win. Please stop. Please. I can't take it anymore. Inflation 20%. Don't make us go all Volcker on you now. Inflation 25%. Where's my index linked retirement package? Time for a new Fed chair to finish the job I started. Sort of. That's the Fed's inflation strategy. Then we have the Russians stagflation driving. Look at the natural gas price. Stagflation is here. Recession 2022. Danger will rob us. And I posted this September 2021. So what do? Look here. Hold assets that are leveraged to inflation. Good housing stocks. Good housing. That's properties in good areas. You don't buy any old crap. Run down property in a bad neighborhood. You have to buy the best housing in the best area. That's what you go for. Area first, then go find yourself a property. Good stocks, as I've covered at length this year, they're accumulating a bit, and good commodities. This is more trading commodities, range trading, because they do move in a range. I'll just stick to the first two. And there's the UK debt smoking. And look at this, 90% GDP, and this is just public, the official figures. The real debt is high off balance sheet. That's why they've monetized. Half of UK debt has been monetized. That's a joke. Half, £1 trillion. Britain's hyper housing market. This is what it was leading into this analysis. There's all my previous analysis over the past 16 years, going back to 2007 when I forecast it would crash. And then I started doing trend trajectories. Look at this 5-year trend forecast there. Yeah, 5-year. Who's gonna put their neck on a block for 5 years? And it tracked it for 3 years roughly. Then you had a deviation there. But 5 years. UK pop. Then I cover the drivers for why what house prices will do, what they're going to do, which is population growth. This is my population growth trend forecast I did in 2010. And what's the actual? This is the actual today. Remains perfect. Look, forecast, actual, right on target. This is one of the primary drivers for UK house prices. This came through it. Then I cover the UK house building and population growth analysis, different ratios, different ways of measuring it. I cover it in extent. growth versus dwellings accumulated ratio. I'm not going to go through in depth, I'll be here for ages. And overcrowding implications for UK house prices. That's what these are. The affordability just getting ratcheted higher, ever higher. See, that was the trend forecast for where it would go. All these people, all these so-called analysts, UK housing is unaffordable, it cannot go up. And my trend trajectory was that it will continue rising. It doesn't matter. Housing will continue to get more unaffordable. And this is what it was at each update. Like this graph was in September 2013. And the latest update was in December 2021. And it's just continued to trend higher. That's the trend line. And that's the trend trajectory. Now it would probably be more slanting that way. Up there. So it's just going to get, it doesn't matter if it's unaffordable, it's just going to get more unaffordable. And this is what it is in real terms, in inflation. Yeah, this is what it is in inflation terms. Real house prices after inflation there. And you got the UK average. So it shows you the real trend to get average UK house price. It shows you the overvalued, they are overvalued. So the trend will be mellower, shallower should I say. But it's not gonna top. UK house prices in GDP terms, it's nowhere near the peak of 2007. So you got room to grow there. Momentum, yes, momentum is high, 10%, but you can chug along between 10 and 7.5% for a while. This is the inflation mega trend in like UK house prices in inflation terms there. It is. The UK house prices are expensive, but the trend is not, it's not gone parabolic. And then let's get jiggy with interest rates. Let's get jiggy like Will Smith slap. Yeah, I gave you all a slap. When I posted this analysis, I gave everyone a slap in the face. If you're waiting to buy, sat on the fence, what are you doing? Look, slap in the face. Stop wasting time that you cannot get back. The bottom line is that UK interest rates are rising to 2% to fight inflation of 8.5%. That's what they were when I did this analysis. It's like a fireman using a water pistol on a towering inferno. So basically I said, I'm giving you the slap in the face to stop faffing about. Just get on the property ladder, fix your interest rates for as long as you can. I'm sure I said that. So savers. So when understand this, understand this. There is plenty of upside to interest rates for normal rates. Equates to well above CPI. CPI is CPI because the real inflation rate is double, which translates into a base rate that should be at least 9%. Of course, that's not going to happen, but they're going to get at least halfway there, probably more. So, you're still waiting. It's too late to... Well, I don't know what... They pulled half the mortgages now. I think it might be too late to fix now. I don't think you can... I think you left it too late, guys. You should have fixed when I was telling you to fix 6 months ago. I think you could still fix up until a few weeks ago. Now they pulled the fixed rates. I know one of my patrons fixed at 3% in the UK for 10 years. Now he won't be able to even get his 6% now. Then we got the analysis of the yield curve. I'm not going to focus on it. UK yield curve inversions, all suggesting inflation. The work from home boom. Yes, that's my room. That's where I sit. Well, you get to see my 3 screen. Yeah, I've got 3 screen. I've actually changed that one now. I've got 3 curved screen monitors. This is the building I was looking to buy, an office building, just to expand my property portfolio. But the price, they upped the price. They upped the price. Have I said it? Yeah, look, it was on the market at 550k, but then it soon shot higher on interest. When you express an interest, the next minute it popped up to 725,000, and then at time of this analysis it was 695, which is too much. I would have bought it for 550k. Now I'm gonna have to wait for a recession and see and try and pick up some distressed selling, but there's always inflation in the background. Obviously, commercial property will be hit by the recession, rising interest and so on, but not residential. That won't be. And here I formulate my house prices forecast. Why they will be higher from now in 2 years' time, and definitely in 3 years' time. Momentum, net migration, overcrowding, inflation, which will exceed 20% per annum. House prices are likely to track RPI inflation rates, so move between a range of about plus 5% to plus 10%, which is still pretty strong. So no declines, no matter. Even though I saw inflation rocketing high and being persistently high, even though I expected interest rates would get to at least half what they should be. They should be like now 10%, but they should get to at least 5%. Even that will not prevent house prices from falling. And there's rampant money, 1 trillion British pounds. The bottom line is that UK house prices are expensive, but there's nothing to suggest that they will not continue to get more expensive over the coming years, all the way to the next mania. And now here is my final trend forecast. There's the graph. Can you see it? Whoa, rocketing high. There is no fall. All those sat on the sidelines waiting for it to fall to buy. You're not gonna be fine. I'll update this the graph in a subsequent video, but remember this analysis was posted in early April. It's a 3-year trend forecast, so now you can check what is the Halifax index now. I can't remember offhand, but at the time of analysis it was 278,000, and I forecast it would rise to 340,000 by February 2025. So from March, a 22.5% rise from March 2022 data to February 2025. That's what the trend forecast was. Then I peer into the mists of time. So it's highly probable that the UK housing bull market will trend higher beyond my 3-year trend forecast all the way into 2027. So that's 5 years. So here's the text. My expectations are for UK house prices to continue to trend higher over the next 3 years, punctuated by a brief pause during early 2023 in response to interest rate hikes, weakening economy and tax rises. Well, they've actually cut the taxes now, or tried to. However, persistent high inflation, extreme overcrowding, and continuing strong population growth ensures that the bull market will remain intact. Therefore, my forecast conclusion is for average UK house prices to target a rise from 278,000 as of February 2022 over the next 3 years to 340,000 for February 2025 data, Halifax data, targeting a price increase of 22.5% over 3 years, as illustrated by my forecast graph here. Look, there's the pause. When did I say the pause would be? Well, the timing is going to be different. I said around mid. It's now looking it's going to come slightly earlier, but it can't be perfect. So what's the Halifax current? Let's have a look what the current price is. What it should be. Let's see what it should be. In September it should be roughly around 295, I think, thousand. So we find out what it is. So there it is, the latest data, 294,000. Forecast is by August, where we are. See, it's hard to line up. This is 1 year. So around here, it is around 295,000. Without going into the Excel spreadsheet and looking directly, it looks like it's 295,000. And actual is 294,000. There is no deviation. The forecast remains on track as forecast 6 months ago. There is no deviation trend. No, people want me to keep updating. There's no point. I made my forecast. I'm not going to change my forecast. This is the trend trajectory. I'm not going to change it. That's not the way I operate. I'm not like one of these. What's the point of making a forecast if all you do is you're going to just change it on every month? That's not a forecast. That's just blowing in. That's like a reed blowing in the wind. What I do is basically a trend forecast is a roadmap against which to measure strength or weakness. The power of the forecast is that it's not based on hindsight. Most people don't understand that. This is how it was in the end of March, early April 2022 that made me conclude in this trend trajectory. So it's a deviation from the forecast, and then there's been some fundamental change that I need to investigate. Yeah, significant deviation. Obviously, there is no deviation. That means we're on track. Like someone now said, "Oh, house prices could go up by 20% by." Yes, based on what? What's the track record? There is none. But this is what was forecast where it would be in April, and it's where it is. So that tells you that this trend trajectory is accurate. Then I paid to Mr. Time. Risk to the forecast. Sorry. Here we go. Sorry if you were hoping that there is a risk that house prices could fall. As a risk I see is that UK house prices enter a mania phase when house price inflation exceeds 20% per annum. However, given interest rate rises and slowing economy and increasing taxes, then a mania during 2022 and 2023 appears unlikely, but it could happen in 2024. Yeah. So, then US house prices. That's going to be my next mega analysis. Trend forecast for UK house prices. So you want access for that, then get it. And also, and now then we have my US house prices trend forecast. Extensive analysis on the same scale, if not more than what I cover in my UK housing market. I actually did this straight after the UK housing market into mid-June, and then I just pressed the pause button because I was focused on stocks. So it's 90% complete. If I can give you the list, the components, it's not here. I'll just put it on top of this video. The list, that coverage of my US housing market analysis that I put the pause button on. However, I did release, for my patrons who were asking me when you're going to post it, I released an interim spread of where the house prices will be in 3 years time, i.e. between this percent and that percent higher. So yeah, no falls. But for that you have to become a patron. Now that analysis will be released after my next mega piece on the US stock market, on the S&P and the Dow. Mega analysis on an epic scale. I've gone full Monty on this. Full spectrum mega analysis that concludes in a detailed trend forecast into September 2023. So a full 1 year trend forecast. So for immediate first access to that and all of my analysis, including my forthcoming US house prices trend forecast, 3 year trend forecast, then do consider becoming a patron and supporting my work for just $4 per month. With my latest analysis on the stock market, literally days away from being final. I'm trying to get it done ASAP. So just a couple of days, it's virtually done. It's just such a mega piece that I have to absorb it. It has to be all in my mind so I can arrive at the detailed trend forecast, because that's what the detailed trend forecasts are like. It's the sum of all of my analysis. And to get that, so that all of this has to be in my head. So I have to keep rereading sections, and it adjusts my neural pathways. So that analysis, that mega analysis, is imminent, and it covers the trend forecast for US stocks for 1 full year. I have to get. I'm going to get it done before 2 days. 90% done. Yeah, about 30 hours of work. So do consider becoming a patron, supporting my work for just $4 per month. My voice is going all croaky now. So remember to subscribe to this YouTube channel for new videos geared towards capitalizing on this stocks bear market that I warned to expect last December. Capitalize on by accumulating AI tech stocks at deep deviations from the highs at target buying levels, which again first being made available to patrons who support my work. So do consider becoming a patron by supporting my work for just $4 per month, gaining access to over 35 years experience, right from before the 1987 crash straight through to this stocks bear market that will ride the quantum AI megatrend into the future.